All right. All right, what's going on, guys? So today I'm going to talk about the next point in my strategy slash our strategy. It is This is one of the things you will use literally like every day. You'll use this for daily buys. You'll use this for so many things. So I want to explain this. It might be a little difficult at first, but it shouldn't be too hard to understand. There's different types of fair value gaps. So the fair value gaps is what I want to talk about today. There's different types of fair value gaps. So I'm just gonna go over bullish fair value gaps. So I'll say that bullish fair value gaps, and then I'll make another video on bearish fair value gaps, which are called inverse fair value gaps. So first I want to go over what fair value gaps even are. Bullish fair value gaps, what even are they? So fair value gaps are when a big move up happens. Say it's going for a liquidity sweep, and there's a big candle that. So this here, let me think about it. Let me think how to explain this. So there's a big candle, right? And you'll see it. The fair value gap is within 3 candles. So right here, there's one. So look, I'll show you. There's one candle. This is the 3rd candle, and this is the 4th candle. So fair value gap is when a gap is created between 3 candles. So you see this big move up here, and you see this candle's top of the wick is right here, and this candle's bottom of the wick is right here, and this candle's body is right here. So this is considered a fair value gap. I'll draw it out for you. So this is a fair value gap. Fair value gap is a level that was created where price did not get filled. The banks did not fill this area with any seller orders or anything like that. So you like 9 times out of 10 will see a fair value gap get filled, and then you'll see it push back up like this fair value gap right here. So this is the first candle right here. Here, wait, let me draw that better. This is the first candle. This is the second candle. This is the 3rd candle. So you see their wicks, the top and bottom of the 1st and 3rd candles wicks. So the 1st candle is right here, and the 3rd candle is right here. So the top of this wick, right here, the top of this wick to the bottom of the 3rd candle's wick is a fair value gap. So you'll see price will come down and enter into here and fill orders so that it can either push back up or it can push down, and you'll know it's in a bearish trend after that, which I'll go over after this. But fair value gaps are usually for they are where a big move up happens and gaps in between 3 candles are created. So in this move alone, there is 3 fair value gaps. So here, so go from the bottom to the top here. Fair value gap created right there, and then there's also a fair value gap down here that was created. So you see from the 1st candle to the 3rd candle, in between there's no seller orders, no black candles, no wicks, no anything. There's only this body of this candle. So this is a gap that price wants to rebalance into. And speaking of which, right now this price is in this first fair value gap created on this big up move, which this big up move was created from a fair value gap. So you see how important this is. The 1st candle to the 3rd candle. So there's 3 candles. A fair value gap is created within 3 candles, and I want to just go over this because I know it's difficult and like super weird to hear. But a fair value gap is created from 3 candles. So you'll see. Count out the candles. 1 candle. I'll put it honestly, I'll just put a letter 1. Let me turn this off. A letter 1. First candle right here. Second candle right here. That's a bad 2. Wow. second candle right here, third candle right here. So you see, this is the first candle right here, this little candle right here, first candle. This is the second, which is the base, the foundation of a fair value gap. And then this is the third candle. And you see that I drew this gap from the bottom of the third wick to the top of the first wick, or vice versa, the top of the first wick to the bottom of the third wick. It doesn't really matter which way you go, but that's how it works. And it really isn't difficult, but you can see that this price will rebalance into these gaps and go out of them. Like, look at this. Rebalance, bull run. Rebalance into this gap, bull run. And then it's just crazy how much you can see. Right now, price is in this gap right here, this 5-minute gap. This is the first candle, this is the second candle, and this is the third candle. There's a gap in between, and price rebalanced into here and is having buyer pressure out of it, which is normal, which is what you want to see. So how do we use this to our advantage? In our strategy, we have a liquidity sweep, a break of structure, which I have gone over in day 4 and day 5. Liquidity sweep, break of structure. This is our strategy. Liquidity sweep, break of structure. And then you want to see a retracement to a fair value gap or an order block, which I will go over order blocks in the future. But right now we go over fair value gaps because this is the easier one to learn. So yeah, let's see here. Usually you can see more in the 1 minute. So yeah, right here. So you see a liquidity sweep of this low, which we went over. Then you see a huge reversal where price came up and went there. Let me connect my paper trading. So price just closed above that. I kind of want to get in just because. Let's do it. Yeah, so we'll see if this goes up, but this is our setup right here. Let's see, where's this at? So this is the setup. A sweep of lows, a fair value gap created, and then price rebalanced into this gap and is now having buyer pressure out of it. I entered on it just to show you, but liquidity sweep, break of structure, retracement to a fair value gap, which I drew out here. But this is the third wick, this is the second wick, and this is the first wick, this is the second wick, and this is the third wick. Then you see the next candle, right? The next candle comes down, pushes into here, and boom, retraces, and you see how the rejection on this wick, once it hits that level, it filled the orders and is now going up. So yeah, there's that. I entered in just because, it's paper trading. It's not real money. But that's the setup. Let's see. Okay, I want to show you when a fair value gap gets invalidated. So, I feel like I went over enough examples. This is a fair value gap. Right here, this is a fair value gap. First candle, second candle, third candle. You go off the first candle's top of the wick, and you go off the third candle's bottom of the wick. Sometimes it's not a wick, sometimes it's just a candle. So the top of the candle to the bottom of the candle. So top of the first candle to the bottom of the third candle, you want to draw out your things. So let's see, let's do this one more time just to really show you. So you see this big move up, and then you see these gaps are created in between. So you see this wick right here is the first wick, the top of the first candle. And then I go up, and the top of my rectangle is going to hit on the bottom of the third candle, the third wick, which that is a fair value gap. And there's usually a retracement into these, oh, look at that. My trade's going downhill, but that's okay. So that's actually a good example for what I want to talk about next if that invalidates the gap. But what I wanted to go over next was what an invalidated fair value gap looks like. So let's see here. Right here. Actually, I want to find one that. Yeah. Okay. All right. Right here. So you see, let me erase this. Let me erase this. So you see the top. So you see this fair value gap right here was created. You go to the top of the first candle, from the bottom of the third candle to the top of the first candle. There's a fair value gap right here. But you see price rejected a little bit off of it, but then it came down and we got a full candle close past it. If we get a full candle close past a fair value gap, it is an invalidated fair value gap. So this right here is no longer a fair value gap because we had this big bearish candle close past it. So its body was close past it. It'd be different if it was a wick like this, where it didn't close past the actual gap, but it totally closed past the bottom of my rectangle and is now going to go down even more. So yeah, let's see. Let's give one more example. Oh yeah, boom, right here. Fair value gap right here. Top of the third candle to the bottom of the bottom of the third candle to the top of the first candle. Hope that's not getting you confused. So you see top first candle, bottom third candle right there, gap in between. Then you see price rejects a little bit, but then you see boom, close past right here. Oops. You see boom, close past right at this level, close past my fair value gap, and that fair value gap is now invalidated. So you want to look for either more bullish order flow to be respected, or you want to see price dump after that. Which in this case it didn't really dump. It retraced into more fair value gaps, which there's a bunch here. One right here, one right here. It respected them. Not only that, but this is an order block, which I haven't gone over yet. You still are learning about that stuff, so I'll go over that in later videos. But yeah, oh yeah, boom, right here. This is a good example. So fair value gap, right? You go from the bottom of the third candle to the top of the first candle. Remember those words: bottom of the third candle to the top of the first candle. And then the third candle is where the actual gap is. So right here, boom. There's a fair value gap right there. 5-minute fair value gap was created, and we're moving up. We're in a big bullish trend. We were huge bullish, but then boom, we got a huge drop down and close past this gap. Once you see this close past this gap, it is now invalidated, and you want to see price go lower, which you saw exactly that. And my trade isn't looking great right now, but you see how this fair value gap, this is a perfect example, which I love this right now. This is a perfect example of a fair value gap. You see that this fair value gap is rejecting all of these candles. It hasn't gotten a close past the bottom of it. So if it closes past the bottom of this gap, I will probably get out of my trade, because that technically for me is a break of structure. But if we see a close past this high, I will be like, let's go. My trade's going to hit. Let's get it. Let's go. But this is a perfect example. This fair value gap, you see this price rebalanced into this fair value gap, and then boom, it retraces. And is now, honestly, it looks like it's going to go up. This looks like a bullish setup, in my opinion. It swept out these lows, and not only that, but it rejected a fair value gap, which is what I'm talking about right now. But there's a fair value gap right here that it rejected off of. You see this wick. It went into this level and started to push up. So, I mean, I don't know if it's going to go up because I can't just predict the market every single second of the day. But this would be a pretty good setup. I entered on a weird whim, but I'm just showing examples. So, boom, that's my trade. Where's my stop loss? I have like a 1.4 risk to reward. So that's my trade. But this is showing you how a fair value gap works. Price will come back into it to fill these orders, and then it will push back up. And yeah, so that is literally the preface of this. You want to see price liquidate any orders. So liquidity sweep these lows right here, swept out these lows, and it reversed. And then you saw a break of structure, which is this reversal here, created a fair value gap, retraced to the fair value gap, and is now breaking structure to the upside. Which, wow, that actually is a really good candle that I like to see. But this is a prime example of how a fair value gap works and how the setup works. As you can see, we just got to close past this high right here. And not only that, but there was a tiny inverse fair value gap, which you guys haven't learned about yet, right here, that we are right inside of. So we'll see how that goes. But yeah, that should be enough examples. Remember, top of the or bottom of the third candle to the top of the first candle, or vice versa if you want to do it the other way. Top of the first candle to the bottom of the third candle. There's fair value gaps everywhere in the market, and you'll start to see them. Just remember my words. Top of the first candle to the bottom of the third candle. You draw your rectangle out like that. So you put the bottom of your rectangle at the top of the first candle, and then you put the top of your rectangle at the bottom of the third candle. And if you go vice versa, then you'll put your rectangle at the bottom of the third candle, and then you'll put the bottom of the rectangle at the top of the first candle. So you see them literally everywhere. Like, they are everywhere in the market. Obviously, you can tell that my trade is probably not going to play out. I'm not sure. It's in a bit of an uptrend right now, create a higher low, and now it's retracing into this fair value gap right here. But we did have a breaker structure to the upside from this top of the wick, but we still have this inverse fair value gap, which is just a bearish fair value gap that rejected this price. So, I mean, we'll see. It's paper trading. I just wanted to show you guys an example of fair value gaps. But yeah, you see how they work. You see, I want you guys to go into the market and go to candles and find the first candle, the third candle. Here, let me see. I want you guys to see the first candle, the third candle, first candle, second candle, and the third candle. So, boom. You see all of these were 1 minute fair value gaps. This is a 5 minute fair value gap because that's the time frame I'm in. Bottom of the third candle to the top of this first candle. Boom, fair value gap right there. That is a fair value gap. But yeah, let me know in the comments if you guys have any questions. It should be pretty simple. I know it's complex to hear fair value gaps and what even those terminologies mean. Oh my gosh, I don't even know what you're saying right now. But once you go and study, you'll learn more. Oh, let's see, my trade looks like it's going up. But yeah, so what did I enter? I'll go look at this. Look at this. Look at this. I'll be a goat. Put a partial take profit right here. At this, look at my trades going. I'm telling you guys, it works. This stuff works. Come on, hit my first take profit. This is crazy. I kind of just cooked this up on the video I'm creating, but so yeah, this is literally a prime example of our strategy. We had a liquidity sweep, then we had a break of structure to the upside, and fair value gap was created. Price rebalanced into this fair value gap, and then it broke structure out of it, and we entered. And boom, look at it now. It's getting a little bit of rejection at this level, but we should see it continue higher. There's this high, which I have a take profit at. Hopefully we'll hit that. It's kind of fun just paper trading sometimes, and really just seeing the setups and seeing how they work. But yeah, I kind of wanted to see this hit at least first take profit. I'm up around 940 almost right now on the paper trading account. Let's see it. Let's see it. Come on. Come on. 8. No. What is going on? This is so funny. Oh my gosh. Prime example of a fair value gap right here. Prime example of my strategy and that it works. The setups aren't always this apparent, but they definitely are you're able to see them once you learn what a fair value gap is. Like, look right here, literally live action. This is the live market. Price is rejecting this fair value gap that was created on this move up, and is now, I could see this pushing up more. I mean, it was literally like not even a point. That's like less than a point away from my take profit. But you see price hits this level and is rejecting a little bit off of it. But yeah, I'm trying to think if there's anything else. Oh, also the middle of fair value gaps, which is also Fibonacci. If you guys learn anything about Fibonacci, that's technically it. So there's a 50% level in fair value gaps that tends to get hit. Like, I don't know, more than 50% of the time, these levels get hit. That's why I have a dashed line in the middle of each of my fair value gaps. So you see this dashed line I have right there. That is the equilibrium, the 50% level of my fair value gap. So usually you don't want to put your stop losses on these levels because they will probably get hit. Price just likes to target the middle of these gaps for some reason. But if there's any questions about that, let me know. And my first take profit was just hit. This is literally a prime example of a good trade. This is an A+ setup right here. I can't believe we just did that literally live. But yeah, this is pretty dope. I'm going to go break even. This is what I would do on a normal. You put your stop loss back to where your entry is so you don't lose any money. Now I just have a runner on this paper trading account, which this is funny because it shows you how well fair value gaps work and how many fair value gaps you'll see in the markets. But yeah, I hope this helped, and I hope you guys have a good rest of your day and lock in.